What if the next big surprise housing crash in California isn't a surprise at all, but something that data is already whispering if you know where to look? In the last major downturn, some California cities saw home prices drop by roughly 30 to 50%, wiping out years of homeowner equity. Today, with prices stretched far beyond local incomes, worsening affordability, and clear signs of outmigration and buyer fatigue, the data points to a new set of California cities at high risk of sharp corrections by 2026. Oakland has long been framed as the more affordable cousin to San Francisco, but that narrative began to strain once remote work buyers and spillover demand pushed prices sharply higher. During the pandemic and its aftermath, waves of buyers priced out of San Francisco treated Oakland as the next logical step, but incomes and local job growth didn't move at the same speed as home values. That's usually the first sign of fragility. More recently, there are signs of demand fatigue. Sales volume is down, listings are sitting longer, and price cuts are becoming more common as sellers walk back peak-era expectations. At the same time, net outmigration from high-cost Bay Area metros continues, with thousands of residents leaving California for cheaper states each year, which undercuts long-term demand. When people leave, but housing stock doesn't, prices eventually have to adjust downward. Layer on top of that higher insurance costs, rising ownership expenses, and persistent concerns about crime and quality of life, and the pool of buyers willing to stretch for Oakland begins to shrink. Investors, who once rushed in expecting quick appreciation, tend to be the first to pull back or sell when the trend turns, adding more supply to the market. If tech hiring in the region slows, or stock-based compensation weakens further, Oakland's overextended segments could see sharper than average price corrections rather than a gentle cooling.
Bakersfield saw one of the most dramatic run-ups among inland California markets during the pandemic era, as remote workers and investors chased cheaper houses away from the coasts. Prices jumped far faster than local wages, a classic sign of a market being pulled higher by external money rather than internal strength. That's a red flag, especially in a region whose economy remains heavily anchored in energy, agriculture, and blue-collar work, sectors that are vulnerable when the broader economy slows. When prices outpace incomes in markets without a deep, diversified job base, demand becomes very sensitive to interest rates and employment shocks. Bakersfield also attracted a large share of investors and flippers looking for yield in lower-priced homes, and those are exactly the players who tend to sell quickly when appreciation stalls or rent growth slows. If enough investor-owned homes hit the market at once, supply in a demand-sensitive city like Bakersfield can spike quickly. Historically, inland and ex-urban markets without strong institutional anchors or global demand have seen deeper percentage declines in previous corrections. If 2026 brings weaker job growth or prolonged high borrowing costs, Bakersfield's recent price gains could prove harder to defend than many owners expect.
Riverside's recent story is almost a textbook example of spillover demand. During the boom, buyers priced out of Los Angeles and Orange County turned to the Inland Empire, with remote work making long commutes feel temporarily irrelevant. As a result, prices moved up aggressively, not because local income surged, but because outside money and flexibility allowed people to bid more. Now that more employers are pushing return-to-office policies, the long-distance commute penalty is back in the equation, and Riverside's affordability is under serious strain. Many households bought near the top of the market at much higher rates than a few years ago, and first-time buyer affordability in the region has deteriorated significantly, according to state indexes. That makes it harder for new buyers to qualify and for existing owners to move without taking losses. Riverside's economic base, logistics, warehousing, and service sector jobs, is also sensitive to cyclical slowdowns. At the same time, new construction in the Inland Empire has added considerable inventory just as demand is cooling, a combination that has preceded larger-than-average price swings in past cycles. If conditions tighten in 2026, Riverside's mix of stretched affordability, commute fatigue, and fresh supply puts it at meaningful risk of a sharper correction.
San Diego is one of the most desirable cities in the country, and that is precisely why it's easy to underestimate its downside risk. It consistently ranks among the least affordable markets in the United States, with median home prices near or above $900,000 and typical households needing far more than recommended income shares to buy. Desire doesn't override math when monthly payments pass a certain threshold. That affordability gap is already visible in shrinking buyer pools and slower sales volume. In a high-price environment, even small changes in mortgage rates translate into large changes in payments, making San Diego highly sensitive to interest rate moves. A big share of local employment is tied to sectors like tech, biotech, tourism, and defense. Any cooling in hiring or compensation there can quickly feed into weaker housing demand. The luxury and coastal submarkets are especially exposed. High-end buyers tend to react quickly to stock market volatility or uncertainty around bonuses and equity compensation, pausing purchases when they feel less wealthy on paper. When volume drops at the top, pricing pressure often filters down into mid-range neighborhoods over the following quarters. Add rising insurance premiums and ownership costs, and San Diego doesn't need a crisis to see noticeable price declines by 2026, just a modest but persistent cooling in demand at today's valuations. Santa Monica sits near the extreme end of California's price spectrum, with home values and cost of living indexes dramatically above national averages. That exclusivity works when confidence and asset prices are strong, but it becomes a liability when uncertainty rises and high net worth buyers pause. Luxury-heavy markets can see sharp volume drops with only a small shift in sentiment. One key vulnerability is simple buyer saturation. After years of appreciation, there are very few new households able to step into Santa Monica prices at current mortgage rates. In a thin market like this, even a modest increase in listings can flip conditions from tight to soft, forcing sellers to negotiate more aggressively on price and terms. In ultra-expensive areas, expectations and psychology drive a large share of the action. Once buyers believe prices have peaked, waiting becomes the default. Santa Monica is also tightly tied to stock market performance and tech-driven wealth in the broader Los Angeles and Silicon Beach ecosystem. If equity values wobble, IPOs slow, or bonus pools shrink, many would-be buyers will delay major purchases. Regulatory constraints and rent controls further reduce investor enthusiasm, trimming another source of demand. In a market this elevated, it doesn't take a wave of foreclosures to push prices down. Thin demand and rising ownership costs can be enough to trigger a correction by 2026.
Victorville illustrates a familiar boom-bust pattern common in high desert and fringe commuter markets. During the pandemic era, buyers pushed farther out from Southern California's core metros in search of cheaper ownership, and investors chased relatively low price points, driving rapid appreciation. But the local economy, limited high-paying jobs, long commutes, and dependence on broader regional growth, never truly transformed to match the new price structure. Many households here rely on long-distance commuting or remote work. If remote work flexibility continues to shrink or transportation costs climb, demand for homes far from major job centers can fall quickly. In places like Victorville, where there is no deep base of high-income local buyers, demand shocks translate more directly into price declines. Speculative buying intensified the risk. Flippers and stretched first-time buyers often assumed refinancing or continued appreciation would fix any budget strain later. If values flatten or decline and credit remains tight, those assumptions fail, and distressed listings can climb. With relatively few physical land constraints, new supply and resales can quickly overwhelm demand, pushing sellers to compete primarily on price. In a slowing 2026 environment, Victorville's volatility could work in reverse, turning past gains into outsized losses.
Yuba City doesn't attract many headlines, but small markets like this often carry concentrated risk. Prices there climbed significantly as buyers left high-cost metros and chased affordability in secondary and tertiary cities. The challenge is that Yuba City's population and job base haven't expanded enough to fully support those higher valuations on their own. The local economy is heavily weighted toward agriculture, healthcare, and government-related work.
These sectors can be relatively stable, but don't usually generate rapid wage growth, which makes it hard for new buyers to afford homes at current prices, especially with higher mortgage rates. When affordability tightens in a small city with a shallow buyer pool, demand can slow abruptly. Unlike larger metros, Yuba City typically lacks international buyers, major corporate relocations, or deep investor demand that can help support prices during downturns. That means even a modest spike in listings, caused by job changes, financial stress, or owners trying to time the market, can move prices noticeably. Historically, smaller markets have shown larger percentage swings in both directions. If the broader California housing market softens in 2026, Yuba City is positioned for a steeper correction than its calm reputation suggests. Sacramento has been marketed as a more stable and affordable alternative to the Bay Area, but the last few years have pushed that story close to its limits. Bay Area migration and investor activity helped drive strong price gains, sending median values far above what local incomes alone would support. With affordability already under pressure statewide, that gap is becoming harder to justify. Investor exposure is a key risk. Sacramento attracted significant rental and build-to-rent investment, but those returns are being squeezed by softer rent growth and rising costs. When investors slow their purchases or begin to offload properties, inventory can ramp up faster than organic owner-occupant demand can absorb. Government jobs provide employment stability, but they typically don't deliver the rapid income growth needed to sustain elevated home prices without continual inflows from higher-paid regions. At the same time, mortgage payments for median-priced homes have jumped, pushing first-time buyer affordability to some of the worst levels in decades, according to statewide metrics. If Bay Area inflows slow as tech uncertainty and return-to-office pressures continue, Sacramento loses a key demand driver. In that scenario, a meaningful price reset is more probable than a smooth plateau, especially by 2026, as the Great Housing Reset Redfin and others describe plays out.
Palo Alto is often treated as immune to normal housing cycles, but from a data standpoint, no market is truly untouchable. Prices here depend heavily on a narrow, very high-income buyer base deeply tied to tech. When that base feels less secure because of volatile stock prices, slower IPO activity, layoffs, or cost-cutting, demand can drop faster than conventional wisdom assumes. A large share of would-be buyers in Palo Alto rely on equity compensation, bonuses, or investment gains to fund purchases. If those income streams stall or feel uncertain, many simply step aside and wait for more clarity. With relatively few home sales each year, it doesn't take many discounted or motivated transactions to reset comparable values and change expectations across entire neighborhoods. Once buyers believe prices have peaked, their willingness to bid aggressively fades, and time on market stretches. On top of that, the friction of ownership has been rising. Property taxes, insurance, and maintenance costs have all increased, and remote work has reduced the absolute need to live within minutes of a Silicon Valley campus for some roles. Historical cycles show that even premium tech hubs have seen meaningful corrections after equity-driven booms. Palo Alto may not crash in the dramatic sense, but a substantial price reset is entirely plausible if tech volatility, high costs, and cautious buyers converge by 2026. Barstow tops this risk list because its recent price behavior is built on some of the weakest long-term foundations. Values surged, largely because Barstow was cheaper than almost everywhere else, not because of strong, durable job growth or sustained income gains. That cheap compared to X dynamic can reverse quickly once financing costs rise and migration flows slow. The local economy is narrow, relying heavily on logistics, transportation, and low-wage service jobs, with limited prospects for broad, high-income growth. There are few enduring demand anchors, like major universities, large corporate headquarters, or unique lifestyle amenities. That makes housing demand highly sensitive to even modest shocks in employment or credit conditions. In small markets, when buyers step back, there isn't a deep bench of replacements. Barstow has also been attractive to flippers and yield-seeking investors because of its low entry prices. If appreciation slows or rental margins shrink due to rising insurance, utilities, and taxes, many of those investors will try to exit quickly. When that happens in a thin market,
inventory can spike and prices can fall fast with very little resistance on the way down. Historically, desert and ex-urban markets have suffered some of the steepest percentage declines during California downturns, and Barstow's fundamentals suggest it could again be among the hardest hit if the state's housing market weakens in 2026.
Housing markets don't really crash out of nowhere. They crack in the places where prices outrun reality, and nobody wants to double-check the math. If this helped you see past the headlines, hit like and subscribe so your next housing decision is guided by data, not hope.